right, here we are with Brandon Go, CEO and co-founder of Treehouse Finance. Brandon, welcome to the Defiant. It's great to have you here.
Thanks for having me, Cami. Really excited to be here.
Awesome. All right, so I'd love to learn more about Treehouse Finance. You guys are working in the fixed income side of DeFi, which hasn't been so developed so far. So I'd love to hear more about kind of how you're innovating in this space. But let's start from the beginning. What's your background and what led you to start Treehouse Finance?
Yeah, sure. So hi, everyone. I'm Brandon. I'm the co-founder and CEO of Treehouse. So background-wise, prior to starting Treehouse, I was at Morgan Stanley doing credit and interest rate derivatives. Before that, I was also in still in the traditional finance world. I was at Wells Fargo doing asset-backed securities. That includes like mortgage-backed securities, like CDOs, a lot of, TradFi packaging, I would say.
Okay. And so from there, why did you decide to go into crypto and start your own startup?
Yeah, for sure. So I started Treehouse 4 years ago when I was still at Morgan Stanley. So by day, I was on the fixed income desk doing, trading fixed income products. But by night, I was very, very active in crypto. We had a very close group of friends, within Morgan Stanley that would come together, and by night we would just be as degenerate as we can be. A lot of these folks went on to start crypto startups, and as some of them got really, really big, like Amber, and a few others started hedge funds. I looked at it as an opportunity to say, hey, maybe you can try something different and try to innovate and bring something new into the DeFi space, given the backgrounds that we had. And the inspiration behind Treehouse really is our goal and vision to bridge traditional finance and DeFi. So that's really how everything kind of started.
Okay, so how are you aiming to do that, to bridge TradFi and DeFi?
Yeah, so the way I look at it is, if we want to get traditional finance involved in crypto, we need to get institutions excited, right? The reality, of course, is that when, if they do start coming properly into crypto, obviously they already have ETFs ongoing. They're not going to be starting at the far end of high beta instruments. They're not going to be degenning into like DeFi plays, right? They're going to start at the safest of safest assets. Similar to how in the traditional finance world, all these institutions hold a big chunk of their portfolio in the safest assets, which is government bonds, and they treat them as risk-free. Obviously, it's not entirely risk-free, but that's the category that they put it under. So I think when institutions start coming into crypto properly, beyond ETFs and just holding spot, fixed income is the next iteration beyond that. And when you talk about something that is safe, something that they're comfortable with, that structurally looks very similar to what they see in traditional finance, we have to build instruments that look very, very similar. I think that's also means starting with staking, something as simple as that, right? Ethereum proof of stake staking, that's a $100 billion market.
Okay, and then why is Treehouse different from other staking and liquid staking protocols? Yeah,
sure. So Treehouse, how we differentiate ourselves is that we're built a whole different new primitive in crypto. In fact, a few weeks ago, DeFi Llama, created a new tag for us. If you get on DeFi Llama, and we're called DOR. DOR stands for Decentralized Offered Rates. So Treehouse and what we do, we call ourselves Decentralized Fixed Income Layer. We think that there's a lot of missing infrastructure in crypto that can bring fixed income products over, and we're trying to help bridge that by starting with benchmark rates. So that's the key distinction. Right now, at this moment, there are benchmark rates that exist in crypto. However, all of them are pretty much centralized. So we're trying to bring across that, the ethos of crypto, which is decentralizing these infrastructure. So there's a lot more trust. It's trust minimalized in that way, and institutions can get comfortable with it. Ultimately, Ethereum, and blockchain in general is decentralized. So I think if we want to build a standard, it should be decentralized as well.
Okay, so you are building a decentralized benchmark rate for DeFi and crypto, and then the idea is to create investment products on top of those rates?
That's exactly right. So the goal is to then, build think of Treehouse as a layer, right? Kind of way, maybe I'll throw the example of Eigen layer. It's a layer for crypto economic security for other networks to build on top of it. For us, it's the similar vein in that Treehouse DOR structure, we think ourselves as a framework, as a fixed income layer, and that can spur the development of new primitives like, staking rate swaps, forwards, Ethereum staking forwards. We want to spur the development of new products that then can, get institutions comfortable.
So how are you creating this decentralized benchmark rate?
Yeah, so I think there are two main products that that Treehouse has. One is called tAsset and one is called DOR. I think that it's very important to understand the first layer first before we can dive right into DOR. So let me start with tAssets. So tAsset is a simple liquid staking token with enhanced yield because there's an underlying strategy below that gives users additional arbitrage opportunity. So underlying our strategy, we work directly with Lido. So we use WST ETH as our base. However, when we take a user's ETH into our smart contracts, it automatically converts into WST ETH. We then scout the market. All of this is done via smart contracts and very much automated. And we'll look for inefficiencies in the borrowing lending market. Three specific reasons why we do that. The first of which is that by doing this, arbitrage opportunity, you can earn additional yield. So it's democratized access to this particular trade. The second thing is that this trade that we're doing, this arbitrage strategy that we're doing on top is extremely important because we're trying to help keep the market efficient. And it will start making sense when I get into the third and final point. Why are we trying to make it efficient? If you draw some parallels to traditional finance world, when you're borrowing, whether it's like buying apples or anything in the real world, it's very rare to see super big mispricings, right? Fragmentation in pricing, right? Imagine going out there and being able to borrow US dollar at 1%, and then immediately being able to then lend it out again at 4% above the US Treasury curve. That kind of opportunities don't really exist because the market in traditional finance is very efficient. If you bring it back to DeFi, however, the borrowing lending landscape is extremely fragmented. It's all over the place, right? At times you can see spreads as big as like 5 to 10%. And if you have such fragmentation in the market, it's very, very hard to build primitives like benchmarks or like what we're trying to achieve here. It's very hard for anybody to take the space as it is because whatever I have, whatever I do, there might be another opportunity out there. So what we are trying to do with tAsset is then allow this strategy to compress the market, to keep it efficient to its rightful rate. And that additional arbitrage yield that we pick up will be given to the users that support us. The third final thing that tAsset does is that it powers DOR. And let me take a pause. I think that's a lot to digest. I'm sure you have some questions.
Super interesting. So, okay, so you take Lido's STETH, and then when it goes into your smart contract, it becomes wrapped STETH, and then you use that or I guess you provide additional yield by seeking these arbitrage opportunities across DeFi. Do you use Lido staked ETH to invest or like to lend it and to lend and borrow in DeFi, or do you use other assets to do that?
Yeah, so specifically for tAssets, we've only launched one iteration in the Ethereum world, and we call it tETH. So at this moment, we're only focused on together with Lido for this strategy. And we basically use that underlying as collateral. And then again, we seek out opportunities on only the top protocols. So the most trusted ones, including like obviously Aave, Compound, Spark. and try to arbitrage the inefficiencies between these three platforms.
Okay, got it. Okay, so you use Lido's STETH, use it as collateral across these three lending protocols on Ethereum, Aave, Compound, and Spark, and find the inefficiencies and arbitrage opportunities in these lending markets to gain additional yield.
That's correct. Yep. And at the same time, as I mentioned, that does the effect of helping keep the market efficient, and which is extremely important if you want to have a whole fixed income asset class. We want to spur the development of this asset class.
Great. Okay, and then so I saw you have a considerable amount of TVL, over 300 million. Is that all in tETH?
We have two. We have another partnership we have with CMETH, so Mantle. So majority of it is in tETH, and then we have like 25% of it sitting in CMETH.
CMETH. So is that a derivative of Mantle, of ETH in Mantle?
METH is the LST token for Mantle, and then CMETH is the restaked version of it.
So you're able to use this 300 million plus TVL that's mostly in tETH to use as collateral across DeFi and arbitrage in all these lending markets.
That's right, exactly. So that's the only goal of tAsset. It's extremely simple. It's done by the smart contract. And it's done on the safest protocol. That's the intention and that's the goal. Yeah.
And so far, how much additional yield have you found that you're generally able to achieve?
Yeah. So historically, we earn on top of STETH anywhere from 20 to 80 bips annually. So 0.2 to 0.8%. But just a few days ago, we made a record 18% APY for one day.
Wow.
And part of that was driven by MEV opportunities, particularly on that day, ETH. So that was 2 days ago, ETH, tanked by like 34 to 40%. It's one of the biggest liquidation events. There was a lot of MEV opportunities. So we were able to then lever on top of that and make users 18%.
Oh, interesting. So beyond finding these discrepancies between lending and borrowing rates, you also do MEV? How do you do that?
We don't do MEV in the sense of Lido's STETH embedded already has MEV, and then we leverage on top of that. So that MEV opportunity basically gets levered. So we don't do that. Yeah. So that question is not really levered. Yeah. Sorry.
So what kind of risks does this strategy have, and how do you mitigate that?
Yeah, for sure. So the way I look at it, and I'll split it into, just when you talk about protocol risk in general, for specific for tETH, I will split it into three segments. The first of which is smart contract risk, right? So when anyone that interacts with any blockchain protocol, within the blockchain, any protocol, there is some smart contract risk. So that includes Treehouse's risk. So on that front, we have done more than 7 audits with 4 different audit houses, including like Trove Bits, Sigma Prime, WatchPuck. Beyond that, there is also the smart contract risk of the protocols that the strategy is embedded into. That includes Aave, Lido, as well as the other two, Compound and Spark. The second risk I would say then is more systemic risk beyond the smart contract. If somehow there is say bad debt on Aave or perhaps Lido. There's additional slashing that is beyond the control of the smart contract. That will obviously impact the underlying, which is what we're holding. The third final risk that exists out there is market risk. So if there is a significant unwinding event on STETH, or there's a depeg of STETH, where oracles are pricing it a lot lower. There is that risk there. In our case, because we're doing that arbitrage strategy, and it's very, very short term, we are pretty much protected in the sense that users would, we can unwind it. And then the second thing I would say is that we do, the kind of amount of collateral that we post on there only represents a portion of the full amount that we have. So all these things are mitigated in such a way that, it requires a very, very big systemic event to happen and beyond that, right? If STU goes down, STU is the biggest protocol in the space, right? It has $30 billion in assets. That is not only going to impact us, but pretty much every single protocol across. And then when you talk about like market risk of Aave as well, that's another thing where if Aave is the second largest protocol, right? These are risks that are systemic in nature.
Right. Okay, so we covered tAssets. Then how does DOR build or work together with tAssets?
Yeah, sure. So maybe before jumping into DOR, I'll just share some context behind how we came up with the idea. So a few years ago, I went up to Chainlink and I went to Band Protocol, so two of the oldest OG Oracle protocols, and I asked them, hey, is there a way that we can work with the both of you to build a benchmark rate? They were very excited. We had a few discussions going, but when we got to the details, we realized that the mechanisms of their oracles couldn't really fit what we were trying to build. So at that point in time, I was I was talking to head of engineering, Ben, and then from the Band Protocol side. A Band Protocol, for listeners that don't know, they're one of the oldest OG oracles as well. Tan went to university with me, one of their head of product, and they kind of both told us that, hey, I don't think it's going to be tough for us to build this with you, given how much mechanism differences that you guys are trying to achieve. So both of them actually came on as strategic advisors to help us then build DOR. Now, explaining what DOR is, I think let's look at it from a traditional finance perspective. I think that's the easiest way for listeners to kind of conceptualize it. So let's go back to the 1980s, right? Let's have a history lesson. So in the 1980s, the fixed income market was big, but it wasn't as big as it is today. So just to also share, like today, the fixed income market is 5 times larger than the equity markets in traditional finance, right? Way bigger than commodities. But when you talk about fixed income in the 1980s, it was a lot smaller. It's comparable to the size of equities. At that point of time, benchmark rates were very fragmented, right? So if you get like a mortgage from Citibank, it would say like the Citibank reference rate on your term sheet. If you go to a different bank, it'll be slightly different. The issue underlying that is that banks then had to warehouse this risk, because if they then got a mortgage review, they couldn't then hedge it out or sell it to another counterparty, because the benchmark or the data metric and the methodologies that they were using were very unique and different. That all changed in 1981 when LIBOR was born. Are you familiar with the London Interbank Offered Rate?
Yep.
Yeah, so when LIBOR was born, it pretty much unified all the benchmarks across the financial markets for US dollar. And that changed the game. Like from 1981 onwards, it was a hockey puck in terms of volume, in terms of new products that started existing in the fixed income world. The year after LIBOR was born, interest rate swaps were developed. Mortgage-backed securities were developed a few years later, and it just took off from there. The issue with LIBOR, as we come to learn as a society, was that it was prone to manipulation and collusion by the banks. So it was very recently replaced with another benchmark called SOFR. The issue underlying SOFR is also that it's extremely centralized, and it's basically only takes data from one particular platform. So bringing it back to crypto and how DOR came about, when you talk about the Ethereum world, Ethereum is decentralized. If you want to build a benchmark, it should be decentralized, right? There's no central bank to come out and say, hey, let's use this benchmark and trust me for this data to be accurate. So we have built principles of LIBOR plus SOFR in the form of in mimicking an oracle with a lot of tweaks. So we've introduced staking and slashing to solve the issue of manipulation. And then we've also introduced stakeholders that are incentivized to work together to provide distributed data to power the system from a data perspective, of course. And then from the other end, incentivize people to query this data. And there's a checks and balance in place where these 5 actors work together to power DOR.
Great. Okay, so specifically, who are these different participants working together to create this rate?
Yeah, sure. So there's 5 participants. The first, at the top, we call them operators. And think of us now bringing back the concept of eigenlayer, right? Mm-hmm. Like eigenlayer is there's AVSs that can build on top of it. Similarly, for us, anyone that wants to decentralize a specific benchmark can be an operator, and they can come up and they can use our tech stack to then build a decentralized benchmark rate. That's what we call an operator. The second actor we have is called a panelist. So right now at this moment, we're working with 15 panelists. We have signed on market makers like QCP, Selene. We also have staking houses like Kiln, RockX, A41, Kiln. I mentioned Kiln already, and a few other folks that collectively come together to provide staking data to help essentially decentralize the feed of the information that is shot to these operators. The 3 other roles that we have, one of which is called delegation. Delegation is that's exactly how tAsset fits into this system, in that users that hold tAssets can stake and delegate their assets into specific operators as well as panelists to help provide security to the system. And finally, the 2 other roles, one of which is called referencer and the other which is the end user. So that can be like the public or the retail using these products that are built on top of DOR. Referencers are protocols that are using our data feeds. We have some very, very strong PhD teams working using like ERC6123 to build staking rate derivatives on top of DOR already. We're working with specific lending and borrowing protocols as well. So these are references that use and consume the data that then kind of pass it up to the end user.
Okay, so wait, operators are those who are creating benchmark rates?
Correct, yeah. So we've kind of acted as the first operator. So we built something called Ethereum staking rate. Okay. That's just one example of it, but anyone in theory can build an operating setting. In theory, you can decentralize SOFR as well. So, right. Say like the Federal Reserve technically can use this DOR as an infrastructure to then make it more trust minimalized.
Okay, so operators issue indices. Then you have the panelists who they gather data from the different sources to feed those indices.
That's one way to think. Yeah, some of them produce that data. So like it could be they have trading data. They're trading on these instruments, and then they just kind of submit it. And then there are others that are more like staking experts, research houses that build models to then feed data into this particular benchmark rate. Okay,
so you rely on these on the group of panelists to make sure that the data is sound.
That's correct.
Okay. All right. And then after that, you have the people who reference or organizations who reference that data for what?
Yeah, so DOR again is like we're trying to build a decentralized benchmark rate. There's many use cases for benchmark, and I mentioned earlier how you can use it to build Ethereum staking rate forwards. In our case, when being the
Okay,
first
so
operator
the
of ESR.
people who are like creating new financial products based off of the different rates that are produced in the system. Okay, so yeah, that's kind of the other participants, and then there's like the end user who are buying these products.
That's right.
Interesting. Okay, and then you created the first of these rates, and it's the Ethereum staking rate.
We call it just the ESR, very simply, right? The DOR ESR. And yes, that actually went live last month, so
Nice.
not too long ago, about 3 weeks ago. And again, as mentioned, we have people building primitives on top of it already.
Cool. Okay, so and the Ethereum staking rate or ESR, the idea is that it represents like an average of Ethereum staking, like liquid staking tokens, I guess, or.
Yeah. So what it actually does is on the spot time frame. So when you look at benchmark data, there's what most people look at is currently like right now at this moment what the rate is. So that is pretty straightforward, right? And there's different methodologies to calculate. You can know what Ethereum staking rate is in this moment by doing a calculation, essentially. Where we deviate from most is that the goal of and the flexibility behind DOR is that we can build term structures. Term structures are essentially basically building beyond the spot time frame what the forward curve would look like. So some of these experts are also providing data that has a time element baked into it, and they will be not only just looking at the spot, which is also important to decentralize, but also the forward.
How do you calculate the forward rate on Ethereum staking?
Yeah, so we use the same principles as traditional finance in how they built a forward curve. One of which is getting trading data, right? So people trade on it, and we're trying to spur the development of this market as well. Essentially, Ethereum staking forwards. The second way is through panelists that are experts of understanding how the mechanism works and trying to. Obviously, it's not going to be perfect, but it's similar to how traditional finance does it with LIBOR, where people provide their predictions of the forward term structure. So there's two fronts behind it. One is through an expert panelist, and then the other front is through trading data.
So in traditional finance, the reason why all these derivative products were developed were to serve specific like real world use cases, right? Like with options in commodities, it was so farmers could just like secure their future income, and then you had traders taking on that risk for farmers to do that, and then in the banking system, they use kind of obviously like the effects on like dollar market to reduce risk for lenders, and so there's like specific use cases behind all these derivative products. So in the case of crypto, why do you think it's important to have these benchmark rates and forward curves and all the products that may stem from that?
Yeah, great question, and a great point as well. So, in our view, I think the very first thing that let's come back to when institutions come into crypto. Right now, last year, Bitcoin ETF was established, right? And then immediately after that, we have ETH ETF. I think the next iteration of institutions coming back into crypto is proof of stake. So when you talk about, we're skipping Bitcoin right now because obviously Bitcoin, you don't put down more Bitcoin to earn Bitcoin, right? It mimics more like a gold kind of a commodity. But when you talk about Ethereum, that it's all changed in that with now proof of stake, I can actually put down more ETH to receive more ETH. It kind of mimics, the traditional finance structure of the treasury curve, right? So now let's put the analogy of putting Ethereum with the United States and treat Ethereum as a country. So at the top, we both have the US dollar, which is the currency used for the economy, and then for the Ethereum economy, obviously it's ETH as the base, right? One level below that, we have the Federal Reserve. We have the Treasury curve that represents the risk-free rate of the dollar, right? It's what the U.S. government can borrow on. Essentially, they have the right to print, so that it should be the safest yield that you should receive in traditional finance. In the Ethereum world, we think, and a lot, there's a lot of conversations, debate behind that should be the proof of stake rate, because proof of stake is extremely systemic, right? If the proof of stake system goes down, Ethereum is dead. And the good thing is that I can actually define a yield on proof of stake. And right now, we can use, say, STETH as that reference, right? It's around 3.5% thereabouts. The problem, however, if we go down one more level down, is that when you look at the US dollar market, there is a whole term structure beyond over there. When you look at the Ethereum market, we're only at the spot rate, and in fact, it's a floating rate. So that rate is being paid out on a day-by-day basis, and it's floating. I think when institutions come in, when they're able to then do proof of stake and earn this yield, the next question they're going to ask is there a way for me to kind of lock in a fixed rate, a return, right? All these institutions they don't want to have uncertainty on their balance sheet of their quarter end of how a rate is constantly fluctuating. It's very hard to explain it. They'd rather just hedge it out and lock it into a term structure. So that's where I think the first iteration, as more and more institutions come into crypto, and when they start doing proof of stake, they're going to need a benchmark rate, and that's what we're trying to solve. So it's very hard to then build all these interest rate staking rate swaps. That's why I term. That only exists when you have a trusted benchmark. So that's what we're trying to essentially solve, that missing infrastructure there.
Okay, so the idea is that institutions or whoever wants a fixed rate on Ethereum staking will be able to secure that with a financial instrument that is based on this benchmark rate, and there will be counterparts who would take the other side of that risk. So those who are more risk averse can get kind of the fixed yield, and then there will be other traders who can take the other side of that.
Yeah, I mean, there's a lot more applications beyond this, and the reason why I've kind of zoomed in on this is because when you look at traditional finance, the interest rate derivatives market is the biggest market by contract value by far, right? That is of all the derivatives that exist in in traditional finance, 90% of it almost is interest rate derivatives. And that same reason of hedging their return of the US dollar, of just like having some certainty behind their balance sheet, that people don't see it. Perhaps retail don't really see that, but whenever a bank issues a mortgage, there's always a hedge underlying behind that. I think that's going to be very similar once the ETH market picks up. But of course, we're not just talking about ETH, right? There's many other benchmarks that can be created. Okay,
so and that takes me to kind of the start to kind of look to the future with you. What are kind of the big milestones that you're working towards, and does that include looking beyond Ethereum potentially and building rates across other blockchains?
Yeah, so I'll kind of segment it into tAssets, and then I'll talk about DOR as well. So from the tAsset side, I'm not sure when this is going to be aired, but we just went live on Pendle today. And right now, tETH is the highest yielding ETH PT asset right now, and just for listeners to note. But really, what we're trying to do is to launch tETH beyond the chains that are already that it's on right now. So we have Ethereum, We have Arbitrum. It's going to be on several new chains. I can't name them right now. Some of the milestones is that right now we have about 25,000 unique wallet holders holding tETH. We want to ramp that up to, on par with WSTETH, in the hundreds of thousands. We also want to build other tAssets. So that means going to other chains and launching similar strategy to how beyond just LST users can earn this lending arbitrage opportunity. Moving over to the DOR side, DOR went live last month. We've onboarded, as mentioned, 15 panelists. We have a project right now that we're working with that we call Project Bamboo. Rationale for the name is just bamboo is the fastest growing plant in the world. And we are working with some of the leading market makers. We're working with 8 DeFi hedge funds, some of the biggest ones in the space, and to come together to spur the development of Ethereum staking forwards. We are targeting to hit 1 billion in notional traded by the end of this quarter, OTC, and then we're also working with some centralized exchanges as well as some perp dexes to bring to life this instrument so anyone can get involved.
Awesome. Okay, and then to wrap up, what's the your long-term kind of big picture vision for Treehouse? Like, where would you want it to be if everything goes right in, I don't know, 5-10 years? Like, what's your big vision for it?
Yeah, I think the goal for Treehouse really is to make fixed income make fixed income a core pillar of crypto, of DeFi, just like the way we see in traditional finance. I think yield benchmarks, and particularly DOR, our goal is to make it a standard where every lending protocol, every new fixed income primitive of sort or can be built on top of that, and we can spur the development of new primitives. Where I see things is that a lot of things will change, of course, right? Traditional finance, as it starts merging with on-chain finance, right? There's going to be more regulation. I think having that decentralized component, bringing trusted benchmarks is extremely critical. So yeah, we're going to work hard to build that foundation to enable a scalable, more secure, and transparent DeFi fixed income world.
Awesome. Thank you so much, Brandon. This is super interesting. And I agree that having a more mature fixed income market in DeFi will be key for the maturity of the space. So great to see what you're building. And thanks again for joining me.
Thanks for having me, Camila.